Level 1. The new agent. IRS. Your first real audit. The guy you're auditing has a better suit than your entire wardrobe. Your first assignment lands on a Thursday afternoon, a manila folder, physical paper, which surprises you. You expected everything to be digital. Inside, a tax return for a hedge fund manager in Greenwich, Connecticut. Reported income, $4.2 million. Reported tax, $680,000. Effective rate, 16.2%. Your neighbor is a teacher. She makes $58,000 a year. Her effective rate is 22%. You've been at IRS Criminal Investigation for 4 months. Before this, you were an accounting major at Ohio State, then 3 years at a mid-sized CPA firm in Columbus doing corporate returns. You passed your CPA exams on the first attempt. You applied to the IRS because the job posting said opportunities to work complex financial cases. And that sounded more interesting than depreciating commercial real estate for a client you'd never meet. The hedge fund manager's return is not complex in the sense of being confusing. It's complex in the sense that every number on it is technically defensible, and the combination of those numbers produces an outcome that requires some explanation. His $4.2 million in reported income consists of $400,000 in salary, which is taxed as ordinary income at the top rate, and $3.8 million classified as long-term capital gains, which is taxed at 20%. His salary, which is the part that looks like a paycheck, represents less than 10% of what he made. The rest came from his share of the fund's profits, which under current law is treated as investment income rather than compensation. This is called carried interest. It's been controversial for decades. It's also completely legal. Congress has discussed changing it approximately 15 times and has not changed it. Your supervisor, a 22-year veteran named Patricia Chen, drops by your desk while you're reading the file. She looks at what you're looking at. First carried interest case? You say yes. Don't get moral about it, she says. That's not your job. Your job is whether he reported it correctly. Did he? You look at the numbers again. As far as you can tell, yes. Then move to the next one, she says. The interesting ones are the ones where they didn't. You move to the next one. Level 2. The field auditor. You drive to a $14 million house to ask for receipts. The housekeeper answers the door. The subject of this audit owns a chain of car dealerships across 4 states. Reported income, $2.8 million. The flag that triggered the audit, $1.9 million in business deductions, several of which look unusual when you read them carefully. You scheduled a meeting for 10 a.m. at his primary residence in Scottsdale because his accountant suggested it, and you agreed because it gives you the chance to see the house, which is its own kind of evidence. The house is 11,000 square feet. There's a car in the driveway, a $400,000 Bentley, that is registered to one of the dealership entities as a floor model for business demonstration purposes. You write that down. His accountant meets you at the door. Accountants who represent high net worth clients in IRS audits have a specific quality. Professionally friendly, absolutely alert, never saying anything that wasn't planned in advance. This one's name is Richard Marsh. He's been doing this for 30 years. He's met agents like you before, many of them. You sit at the kitchen table and you start going through the deductions line by line. The $340,000 categorized as travel and entertainment. Supporting documentation. Marsh produces a binder. You flip through it. There are receipts. Dinner at a steakhouse in Las Vegas, $8,400 for a table of 6. A chartered boat in the Bahamas, $47,000 with a note that says client entertainment prospective fleet purchase. A 2-week stay at a resort in Tuscany, $62,000 listed as an international dealer conference. You look up the International Dealer Conference. There is no record of an International Dealer Conference at that resort in that time period. You write that down. The Tuscany trip alone is a $62,000 deduction. At his tax rate, that deduction saved him roughly $21,000 in taxes. The trip cost $62,000 and reduced his tax bill by $21,000, meaning the effective cost to him was $41,000. The federal government subsidized $21,000 of his Tuscany vacation. This is the mechanism. Not fraud, necessarily. Just deductions that require substantiation and substantiation that ranges from solid to creative to absent. Your job is to find out which is which and put numbers on it. By the end of the day, you've identified $420,000 in deductions with questionable or missing substantiation. The proposed additional tax, $147,000, plus penalties, plus interest. Marsh looks at the number. He doesn't flinch. He's seen bigger numbers. "We'll appeal," he says. "You knew he'd say that. You filed a report anyway." Level 3. The specialist. You're assigned to a high net worth unit now. The returns you audit have more pages than most novels. The high wealth unit of the IRS, officially called the Global High Wealth Industry Group, exists because at a certain level of wealth, a single return can be so interconnected with related entities that a general agent simply doesn't have the time or the context to evaluate it properly. One person, dozens of entities, trusts, partnerships, S corporations, foreign accounts, real estate holdings, private foundations. You've been assigned to one. The subject is a real estate developer. Personal net worth, estimated by Forbes, $1.8 billion. Reported taxable income for the year. Under examination, $0. Not zero, as in a rounding error. Zero. Negative, actually. A $23 million loss that carried forward from the prior year. The mechanism is depreciation. Real estate assets can be depreciated over a set schedule, which creates a paper loss even when the underlying asset is appreciating in value. The developer owns $600 million in commercial real estate that has increased in value every year for the last decade. He is also, according to his return, losing millions annually because the paper value of the depreciation exceeds the income the properties generate. When he sells a property, which he does occasionally to fund other acquisitions, the gain is typically deferred through a 1031 exchange, which allows the proceeds to roll into a new property without triggering a tax event. He has done this 11 times in 8 years. His accountants are a white shoe firm in New York. 3 partners and 7 associates are assigned to this return. You are one person. Patricia assigns you 2 supporting agents. The audit takes 14 months. At the end of it, you've identified $8.4 million in improperly characterized deductions and 1 partnership allocation that you believe misrepresents the economic arrangement among the partners. The proposed additional tax is $3.1 million. The developer's team appeals. The case goes to tax court. It settles 2 years later for $1.4 million, less than half your original finding, but something. The legal fees his team spent fighting the assessment were, of course, fully deductible. You close the file, you open the next one. Level 4, the international case. The money is in the Cayman Islands. The company is in Delaware. The owner is in Miami. Nobody lives where they say they live. The referral comes from FinCEN, the Financial Crimes Enforcement Network. A pattern in wire transfer data, a series of payments from a Delaware LLC to an account in the Cayman Islands, then back to a different account in the US, then out again to a trust in the Cook Islands. The US account belongs to a technology entrepreneur. His lifestyle, documented on Instagram, which is its own kind of financial disclosure, suggests income significantly in excess of what appears on his return. You request his foreign account reports. The FBAR, Foreign Bank Account Report, requires U.S. persons to disclose any foreign financial account over $10,000. He filed one. It lists one account. The account has a relatively modest balance. What it doesn't list is the beneficial interest he holds in the Cayman structure, which is technically owned by a foreign entity, but which under U.S. tax law is his for tax purposes because he controls it. The distinction between I own this account and I control this structure which owns this account is where a significant amount of offshore tax planning lives. The law says control equals ownership for tax purposes. The structures are designed to create enough layers that control is deniable or at least arguable. You spend 4 months tracing the structure. The Delaware LLC is managed by a registered agent that serves 4,000 other entities. The Cayman entity is administered by a trust company in Georgetown that does not respond to informal requests. You submit a formal request through the Tax Information Exchange Agreement between the U.S. and the Cayman Islands. The response takes 7 months and contains partial information. The Cook Islands Trust is administered by a trustee who is a New Zealand citizen and who informs you through counsel that Cook Islands law does not require disclosure of trust beneficiaries to foreign governments, including the United States, in response to civil tax inquiries. You escalate to criminal investigation. The case becomes criminal not because the offshore structure is inherently illegal — offshore accounts are legal when properly disclosed — but because the failure to disclose it, combined with the evidence of unreported income flowing through it, meets the threshold for willful tax evasion. The entrepreneur is eventually charged. His plea agreement requires him to pay $4.2 million in back taxes, penalties, and interest, and a separate $1.8 million FBR penalty for the failure to report. He does not go to prison. He does not go to prison because his cooperation with the investigation provides information about the structure of a larger tax shelter scheme that his advisors had been selling to other clients, and that cooperation is worth more to the government than the sentence. The scheme had 43 other clients. You spend the next 3 years on those files. Level 5. The pattern. After enough of these cases, you stop being surprised. You start seeing the same moves over and over. 15 years in. You've worked maybe 200 high net worth audits. At this point, the specific names matter less than the patterns, because the patterns are what tell you where to look. Here's what the patterns look like from the inside. The art donation. A wealthy collector donates a painting to a museum. He claims a deduction for the fair market value, say $8 million. The painting was purchased 10 years ago for $900,000. The $8 million appraisal was conducted by a firm that does a significant amount of work for collectors in his social circle. You request a second appraisal. It comes in at $4.3 million. The difference in the deduction, $3.7 million, represents approximately $1.3 million in avoided taxes. The original appraiser defends his valuation. You send the case to Art Appraisal Services, the IRS's internal team. They come in at $4.1 million. You propose an adjustment. He appeals. You settle at $5.2 million. He still got a better deal than if he'd sold it on the open market and paid capital gains, the conservation easement. A developer buys 400 acres of land in rural Georgia for $2 million. He donates a conservation easement on the land, a legal restriction preventing development, to a land trust. The land trust values the easement at $11 million, meaning the developer claims an $11 million deduction for giving up the right to develop land he had no current plans to develop. He takes his share of the deduction and sells deductions to other investors through a partnership structure, which is the part that crosses into what the IRS considers an abusive tax shelter. Conservation easements have been on the IRS's Dirty Dozen list of abusive transactions for years. They are also still being sold. The management company. A successful physician earns $2.4 million from her medical practice. Rather than taking that income directly, her accountant establishes a management company owned by her family trust that charges the practice management fees of $900,000 per year. The practice deducts the management fees. The management company pays tax at a lower rate on the income received. The net effect is to shift $900,000 from the physician's high ordinary income bracket into a lower taxed entity. Whether this is legitimate depends on whether the management company actually performs services worth $900,000. You request documentation of those services. The documentation is thin. The adjustment goes to appeals. Her attorney argues that the structure reflects legitimate business operations. You argue that it's a mechanism to shift income with minimal economic substance. You settle at $400,000 in additional tax. The physician's attorney bills her $180,000 for the appeal. That's deductible too. Level 6. The honest answer. What 15 years of auditing the 1% actually teaches you. People ask you at dinner parties when they find out what you do whether rich people pay their taxes. The honest answer is, it depends what you mean by pay their taxes. They pay what their returns say they owe, usually. The ones who don't, the outright fraud cases, the offshore concealment, the fabricated deductions, those exist, and they're a significant part of what your unit works on, but they're not the majority of what you see. The majority of what you see is something different. It's a legal system that was written over decades with significant input from people who benefit from its complexity. And that complexity creates opportunities that are available to anyone who can afford the advisors who know how to use them. The physician with the management company isn't breaking the law. She's using a structure that the law permits. The real estate developer depreciating his appreciating assets isn't cheating. He's using a provision that Congress created and has repeatedly chosen not to change. The hedge fund manager paying capital gains rates on his compensation isn't evading taxes. He's taking advantage of a classification that his industry lobbied for and obtained. The tax code is not a set of rules imposed on people. It's a negotiated document that reflects who had enough power at enough moments to write in the provisions that benefited them. What you audit is not cheating, mostly. What you audit is the outcome of that negotiation, applied to individual returns, one at a time. What your job actually consists of, finding the cases where the application of those provisions goes beyond what even the generous reading of the law permits, where the appraisal is not just favorable but fabricated, where the management company does not just provide minimal services but provides none, where the offshore structure is not just complex but deliberately concealed. Those cases exist. You find them. Sometimes you win. Sometimes you settle. The legal fees on the other side are always deductible. You go home, you make dinner, your neighbor's kid asks what you do for work. You say you work at the IRS. His face does the thing everyone's face does. So you audit people? Yeah, you say. Something like that.